All right, so real quick, going to show you some of what I do for using an options profit calculator to try to give me like a good estimation of the probability of a profit in the position that you want to take. So like if you've got a good idea for something or you see something out there, you're like, okay, well this is doing pretty good. Like let's go ahead and sell some put spreads against it, so that way we can generate some cash revenue. Now you'll see some people that like to buy put spreads that are have more than 30 days on them or are way out there in time. That way you have enough time to adjust if something happens. But for me, some of the times what I like to do is buy them, or I should say sell them 2 days out from expiration. So you can get a little bit of premium, but you're not having to have a whole bunch of margin held aside as insurance in case those things do get assigned. So what I mean by that is if you get into a position where you've sold a put and that put has a margin requirement of like $20,000, and so $20,000 is now set aside for an entire month that you can't do anything with, I hope you're getting the enough return on it to actually make it worth your while to have 20 grand sitting doing nothing just as a backup for insurance. So one of the ones I'll show you today we'll look at is XOM. So XOM. So when you go to use this, I'll start out with showing you that first. So when you go to use this, something you can do is you can go up to, what I like to do is the put spreads. Okay, you select it, and what it's going to do is it's going to pull up the stock with the current price that it's trading at, and then you're going to buy a position and then sell a position. So let's say, for example, if you wanted to, this stock's trading at 107.20, right? And if you look at the option chain for it, let me pull that up. Nope. If you look at the option chain for it, you get this. Now, I'm using Fidelity's Active Trader Pro. It has the ability to show you the order flow. It'll even show you the order flow on the website too, but you can see the order flow for what things have been, which contracts have the most volume and purchases. And it looks like, let's see if the stock's trading at 107. So these are all out of the money. And if you look, you can see that a large interest has been taken in the 106, 105 strike range, and then another one further down, which kind of looks like to me that someone is selling their puts right here at collecting anywhere between $91, $95 per contract, and then to protect themselves in case the stock drops, they're buying them at $18, between $15 and $18 down here on the low side. And if you haven't looked up what a put spread is, I highly recommend you go to Investopedia and look up put spread, and it will actually give you a really in-depth detail. But it's pretty much, this is a more safer way to sell puts than just to sell a put with no downside protection. And when I say no downside protection, if you sell a put here and you're getting that $95 premium, that's great. But if there's bad news tomorrow and the stock price plummets from 105 all the way down to $90, that's going to be pretty expensive. And plus the requirement on margin is a lot less if you have downside protection purchased with the same strike, or not same strike, sorry, it's the same expiration date, but with a lower strike. Then the amount you're only required to handle or be required to hold set aside would be the difference, which is the difference between the strike values. And that is what would be your loss. So yeah, think of it like a little insurance policy on the insurance policy that you sold. So that way you're not in it for the full ride all the way down from $105 to $1. You're only in it for that $5 difference, and then somebody else picks up the tab on the rest of it. But yeah, this is great because you can see where a lot of the interest is, because there are people who have quite a bit of money that would be able to, they'll make it ride on what statistically is looking good for them. So this if you think about it, this means that there's 3,527 contracts that were sold at roughly $1.30 times 100, so $130. Let's see what would do the math on that. So 130 times the 3,527. So $458,000 worth of contracts in just that one strike zone. But if we were to go here and you can actually model it, so let me pull it back up. Okay, that's going to be October 28th in 2 days, and that's the $100 strike put. Okay, so that's the one we buy. 28th, and it's a $100 strike on the put side. Got it. Okay, and I think for what I did, I purchased I purchased 15 of them, and then I sold 15 of them. So purchase 15, sell 15. And the one I sold was at the 105 strike, and I sold it for 77 cents. So 105, 77. Okay, and I'm looking back at it real quick. The one that I purchased was for 14. Okay, so what this did was you have your long put, the one that I bought with a $100 strike, so it's $5 less than the strike that I sold, and the one I purchased only cost me $14 per contract. 15 contracts is $210. The put that I actually sold, I sold 15 contracts, and each one was 77 cents times 100, $77. So $77 per contract, meaning that I would purchase 100 shares times 15 contracts at $105 if it dropped below it. For doing that, those contracts, selling them, brought in $1,155. Now, the difference of the spread is going to be the cost of the protection, which is $210, minus the profit I would have made of selling the contracts, which is $1,155. So if you do the calculation, it's this position to get into this trade or this transaction, it cost me, or I have received a credit of $945, which is $945. Now, the cool part about this site, optionsprofitcalculator.com, is it actually will show you the probability of profit. So based off of this spread setup, I'm looking at an 87.3% of profitability. So if I hold it for the next couple of days, it only has to last till Friday. As long as it stays above, let's see, as long as it stays above my 105, I'm going to walk away with a full profit. But if it drops below that, I have some downside protection from the other put contracts that I purchased to protect my position that I'm in. Let's see, max return. So it runs the numbers for you, which is great. And then that's the actual position that I got into. And I think, let me open this. I'll take a screenshot of it real quick. So yeah, and as time decay happens, okay, and as the price remains above the 105 strike, this value of this contract to whoever purchased it from me will continue to go down, meaning that I keep more of the premium all the way until the date of expiration. Now, that's the same way for the contract that I purchased, the 15 that I purchased for protection. I purchased at the $14 price point. As time passes, is if the stock starts going down, which it went down a little bit. I think it dropped like $1 or something after I made the purchase. So because it went down, the value of the put that I sold started going up because it's becoming more valuable. And the put contracts that I purchased started going up in value because as the stock goes down, those put contracts for protection of downside start going up as well. So that's where this gain happened. But come tomorrow, as long as the stock remains above both these strikes, you will see the contracts start becoming more and more less valuable. So typically when you get set up to do these, you're going to go into the trade window and you'll open up option chain, and then you'll click on whatever the ask bid is that you want to put on there. And as you do it, each time you do it, it puts a leg in there. And for these, you want to make sure that you set it up correctly. So you're going to sell to open your position that you're making your bulk of your profit off of, right? So it's going to be at a higher strike price, closer to what the stock is trading at now. And then you're going to buy downside protection in case the stock drops. So you're not having to pay a whole bunch of money for writing it all the way down to zero or to $10. See, buy to open. You're going to have the expiration dates are going to be the same on both of them. And then you're going to look at where those strike prices are right there and the fact that it's a put. And you're going to be doing a net credit because you're selling contracts that cost way more than the contracts that you're buying. So that's going to be a net credit. And there's usually a graphic it'll show you to let you know like where things are, where's the midpoint, the bid, midpoint, ask. Typically, if you want it to execute immediately, you're going to go right for that bid point, which is 0.73 in this case. Typically, if you don't mind it taking a little bit, you could then shoot for the midpoint and wait and see how things are moving around. Typically with option stuff, it does move pretty drastically throughout the day, especially if there's a pretty volatile market. So you might not have to wait long, or you might have to go in there and make some adjustments. It just depends. You got to keep an eye on it. But yeah, once you get this all set up, then you're going to go hit preview, and then it'll ask you if you want to execute it. It'll probably give you a warning saying that, hey, this is going to require some margin, and that you're going to not want to day trade on this because this is actually quite a large transaction that's taking place. But if you told me that your probability of profit is 87.3%, that's pretty darn good. That's something you can bet on is going to be a pretty good outcome, especially with you don't have a lot of days to worry about something popping up or something happening. It's only 2 days, so and I know a lot can happen in 2 days, but hopefully things stay stable and you're set. And the good thing about doing this with like something like XL or ExxonMobil or XLE or anything that's big blue chip is that if you do get assigned, right, you have a higher probability of making it back by just selling covered calls against it the following week. So yeah, hopefully that helps you out. Let me know if there's any questions in there. Put them in the chat.